The world runs on oil, and most people don't realize how fragile that system actually is. Every day, millions of barrels of crude oil travel across oceans, pass through narrow choke points, and fuel everything from transportation to electricity to food production. But what happens when that system suddenly breaks? That's exactly what the current Iran oil shock is about to test. Right now, a major disruption is unfolding in one of the most critical energy routes on Earth, the Strait of Hormuz. This narrow passage connects the Persian Gulf to global markets, and under normal conditions, nearly 20% of the world's oil supply flows through it. When that flow is interrupted, the effects don't stay local, they ripple across continents, economies, and everyday life. Recent developments have pushed the situation to a dangerous level. The ongoing conflict involving Iran has led to severe restrictions in oil transportation, with reports suggesting that a huge portion of global oil flow has been blocked or delayed. This isn't just a regional issue anymore, it's quickly becoming a global economic threat. Historically, oil shocks have always had massive consequences. In the 1970s, when oil supply was disrupted due to geopolitical tensions, prices skyrocketed, inflation surged, and economies entered recession. What we are seeing today carries many of the same warning signs, but on an even larger scale. One of the key reasons this situation is so dangerous is how interconnected the modern world has become. Countries like China, India, Japan, and even Bangladesh depend heavily on imported oil. When supply chains are disrupted, prices don't just go up, they become unstable. Businesses struggle to plan, governments panic, and markets react unpredictably. At first glance, things may not seem that bad. Fuel is still available, prices are rising, but not exploding everywhere at once. But this is where the real danger lies: the delay. Oil doesn't move instantly. Tankers already at sea continue delivering supply even after a disruption begins. Strategic reserves are released to calm markets. Governments try to control the narrative. But beneath that temporary stability, a gap is forming. As existing shipments dry up and reserves begin to run low, the true scale of the shortage starts to appear. This is when prices can spike suddenly and violently. Analysts are already warning that physical oil prices in some regions have surged far beyond what futures markets suggest, indicating a disconnect between reality and expectations. And that disconnect is dangerous. Markets operate on expectations, but economies operate on physical supply. When those two diverge, it creates confusion, panic, and sometimes chaos. Businesses that rely on stable fuel prices suddenly face unpredictable costs. Airlines, shipping companies, and manufacturers all feel the pressure at the same time. Another critical factor is fear. In previous oil crises, panic buying played a major role in driving prices even higher. Buyers didn't just purchase oil for immediate needs, they stockpiled it, expecting future shortages. This behavior amplified the crisis far beyond the actual supply loss. We are already beginning to see similar patterns today. Governments are considering energy-saving measures, companies are adjusting operations, investors are watching closely, trying to predict what comes next. But the truth is, no one fully knows how severe this shock will become. What makes this situation even more complex is the geopolitical dimension. Oil is not just an economic resource, it's a strategic weapon. By controlling supply routes or restricting exports, countries can exert enormous pressure on global markets. In this case, Iran's position gives it significant leverage. By influencing traffic through the Strait of Hormuz, it can disrupt not just its own exports, but also those of other major oil producers in the region. That means the impact is multiplied, not limited. And the numbers are staggering. Even a small percentage drop in global oil supply can trigger massive price increases, but current estimates suggest disruptions on a scale that could rival or exceed the biggest oil shocks in history. As prices rise, the effects spread quickly. Fuel becomes more expensive, transportation costs increase, food prices go up, inflation accelerates, central banks face pressure to raise interest rates, which slows economic growth. This combination, high inflation and low growth, is known as stagflation, one of the most difficult economic conditions to manage. And that's exactly what experts are starting to fear. Even stock markets, which sometimes appear calm on the surface, are beginning to show signs of concern. Analysts warn that the oil shock could undermine economic stability, forcing governments to make difficult decisions. At the same time, not all regions are affected equally. Some countries, like the United States, have strategic reserves and alternative supply sources that help cushion the impact. Others, especially import-dependent economies, are far more vulnerable. This imbalance creates another layer of complexity. As some countries struggle more than others, global economic inequality increases, trade relationships shift, political tensions rise, and in extreme cases, it can even lead to further conflict. So when we say the Iran oil shock is about to hit, it doesn't mean a single moment. It means a process, one that unfolds over weeks and months, gradually revealing its full impact. The early signs are already here: disrupted supply chains, rising prices, market uncertainty. But the real question is not whether the oil shock will happen. The real question is how severe it will be and how prepared the world is to handle it. Because if history has taught us anything, it's this: oil shocks don't just affect oil markets, they reshape the entire global economy. The first phase of an oil shock is rarely visible to the public. It doesn't begin with empty fuel stations or sudden economic collapse. Instead, it starts quietly, deep inside global supply chains, where delays, rerouting, and uncertainty begin to reshape the flow of energy long before people feel the consequences. Right now, that hidden phase is already underway. When tension rises around the Strait of Hormuz, shipping companies don't wait for a full shutdown before reacting. Insurance premiums for oil tankers begin to rise sharply. Some insurers refuse to cover vessels entering high-risk zones altogether. Without insurance, ships don't move. It's that simple. This creates the first bottleneck. Even if oil is technically available, getting it from point A to point B becomes slower, more expensive, and far less predictable. Tanker operators start rerouting shipments, choosing longer and safer paths instead of the shortest routes. A journey that once took days may now take weeks. And time in the oil market is everything. Every delay tightens supply. Every extra day at sea reduces the amount of oil available in the market at any given moment. It's not just about how much oil exists, it's about how fast it can move. As this slowdown spreads, refineries begin to feel the pressure. These facilities operate on tight schedules, relying on a steady flow of crude oil to maintain production. When shipments arrive late or in smaller quantities, refineries are forced to cut output. That's when the second phase begins. Less refining means fewer finished products: gasoline, diesel, jet fuel. Even if crude oil prices haven't fully spiked yet, the prices of refined fuels start rising quickly. This is often the first sign consumers notice. Airlines adjust ticket prices. Shipping companies add fuel surcharges. Public transportation systems face higher operating costs. The impact starts spreading through the economy, layer by layer. But here's where things get more complicated. Not all oil is the same. Different refineries are designed to process specific types of crude. If a refinery suddenly loses access to its usual supply, it can't always switch to another source easily. This creates mismatches, situations where oil exists somewhere in the world but can't be used efficiently where it's needed. This mismatch amplifies the crisis. At the same time, countries begin to tap into strategic reserves. These reserves are meant for emergencies exactly like this, and releasing them can temporarily stabilize markets. But there's a limit. Reserves are not infinite. Using them too quickly creates another risk. What happens if the crisis lasts longer than expected? Governments must balance short-term stability with long-term security, and that decision is never easy. Meanwhile, traders and investors play their own role in shaping the situation. Oil markets are heavily influenced by expectations. When traders believe supply will tighten, they start buying aggressively, pushing prices higher even before shortages fully materialize. This creates a feedback loop. Rising prices signal scarcity. Scarcity drives more buying. More buying pushes prices even higher. And just like that, the market begins to move faster than the physical reality on the ground. This is why oil shocks often feel sudden, even though they build slowly. By the time the public notices, the system is already under stress for weeks or even months. Another critical factor is storage. Countries and companies maintain storage facilities to manage supply fluctuations. During stable times, these facilities act as buffers, smoothing out minor disruptions. But in a major crisis, they can quickly become part of the problem. If companies expect prices to rise further, they may choose to store oil instead of selling it immediately. This reduces available supply in the market, pushing prices up even more. It's a strategic decision and a risky one. If too many players hold back supply at the same time, the shortage becomes worse than it actually needs to be. But from an individual perspective, the incentive is clear. Hold now, sell later at a higher price. This behavior has been seen in nearly every major oil shock in history, and it's starting to appear again. On top of that, currency fluctuations add another layer of pressure. Oil is typically traded in US dollars. When uncertainty rises, the dollar often strengthens as investors seek safety. For countries with weaker currencies, this makes oil even more expensive, regardless of the actual price per barrel. This is particularly challenging for developing economies. They face a double impact: higher global prices and weaker purchasing power. Governments may try to subsidize fuel costs to protect consumers, but that strains public finances. Over time, these subsidies become harder to sustain. And when they are reduced or removed, prices at the pump can rise sharply. This is often when the crisis becomes visible to everyday people. Fuel shortages, long lines at gas stations, rising transportation costs, increased prices for basic goods. These are the symptoms that signal the oil shock has fully arrived at the consumer level. But even at this stage, the situation is still evolving. Industries begin to adapt in different ways. Some reduce production, others pass costs on to consumers. A few may shut down temporarily if operations become unprofitable. Each decision adds another ripple to the economic impact. Agriculture is one of the most affected sectors. Modern farming relies heavily on fuel for machinery, irrigation, transportation, and fertilizer production. As fuel costs rise, so does the cost of food production. Eventually, this leads to higher food prices, which can have serious social and political consequences. History shows that rising food prices often lead to unrest. It's not immediate, but it builds over time. When basic necessities become less affordable, public frustration grows. Governments face increasing pressure to act, sometimes leading to policy changes, subsidies, or even political instability. And all of this can stem from a disruption in oil supply. Another overlooked aspect is the psychological impact. Uncertainty changes behavior. Businesses delay investments, consumers cut spending, markets become more volatile. Even those not directly affected by higher fuel costs may adjust their actions out of caution. This collective shift slows economic growth. And that brings us to one of the most important questions. Why hasn't the worst happened yet? The answer lies in timing.
Right now, the world is still consuming oil that was produced and shipped before the disruption reached its peak. There's a lag between cause and effect. This lag creates a false sense of stability. But as time passes, that buffer disappears. New shipments reflect the new reality: higher costs, longer routes, reduced availability. This is when the full impact begins to show. And when it does, it often comes faster than expected. Because once the system crosses a certain threshold, small changes can trigger large reactions. Prices can spike suddenly, supply gaps can widen quickly, and recovery becomes more difficult. That's the nature of an oil shock. It builds quietly, spreads gradually, and then hits all at once. The world is currently somewhere in the middle of that process. The early disruptions have begun. The supply chains are under pressure. The warning signs are visible. But the most intense phase may still be ahead. And when it arrives, it won't just test energy markets. It will test the resilience of the entire global economy.
When an oil shock reaches its critical point, the transition is almost never smooth. It doesn't rise gently or predictably. Instead, it behaves more like pressure building inside a sealed system, quiet at first, then suddenly explosive. That moment, when prices begin to surge uncontrollably, is where the real economic damage begins. And the world may be getting very close to that phase. Oil prices are not just numbers on a screen. They are deeply embedded in the cost of nearly everything. When crude oil becomes more expensive, it doesn't stay confined to energy markets. It spreads rapidly through transportation, manufacturing, agriculture, and ultimately into the prices people pay every day. The first major signal of escalation is usually a sharp and sustained increase in crude oil prices, not a temporary spike, but a persistent climb that resists correction. This is often driven by a combination of real shortages and market expectations. At this stage, traders stop asking whether supply will tighten. They start assuming it will. That shift in mindset changes everything. Buying becomes more aggressive, selling becomes more cautious, volatility increases, prices begin to move faster and with larger swings. Even small pieces of news, a delayed shipment, a political statement, a minor conflict, can trigger major reactions in the market. This is when oil stops behaving like a commodity and starts behaving like a crisis indicator. Historically, similar patterns were seen during the 1973 oil crisis and later during the 1979 oil crisis. In both cases, supply disruptions led to rapid price increases, but the real damage came from how those increases spread across the global economy. We are beginning to see the early structure of that pattern forming again. As oil prices rise, fuel prices follow. Gasoline, diesel, and jet fuel become more expensive almost immediately. Transportation costs increase across the board, from shipping containers across oceans to delivering goods within cities. This creates the first wave of inflation. Products that rely heavily on transportation, food, consumer goods, raw materials, begin to cost more. Businesses face higher operating expenses and must decide whether to absorb those costs or pass them on to consumers. Most choose to pass them on. This leads to a chain reaction. Higher fuel costs lead to higher production costs, which lead to higher retail prices. Consumers begin to feel the impact in their daily lives, at grocery stores, at fuel stations, in utility bills. And this is just the beginning. The second wave of inflation comes from expectations. Once businesses and consumers expect prices to rise, they begin adjusting their behavior. Workers demand higher wages. Companies raise prices preemptively. Contracts are renegotiated. Inflation becomes self-reinforcing. Central banks, such as the Federal Reserve, are then forced into a difficult position. Their primary goal is to control inflation, but the tools they use, mainly raising interest rates, can slow down economic growth. This creates a dangerous balancing act. If rates are raised too aggressively, borrowing becomes expensive. Businesses reduce investment, consumers cut spending, economic growth slows down, sometimes sharply.
But if rates are not raised enough, inflation can spiral out of control. This is how economies can fall into stagflation, a rare and difficult situation where inflation is high but economic growth is weak or even negative. Stagflation is particularly challenging because the usual solutions don't work well. Measures that reduce inflation can worsen unemployment. Policies that stimulate growth can increase inflation. It's a trap that policymakers struggle to escape. During the oil shocks of the 1970s, many economies experienced exactly this scenario. Growth slowed, inflation surged, and recovery took years. Today's global economy is even more complex and interconnected, which could make the impact even more severe. Another important factor is the stock market. At first, markets may appear resilient. Investors often believe that central banks or governments will step in to stabilize the situation. But as the reality of higher costs and slower growth becomes clear, confidence can begin to fade. Corporate profits come under pressure. Companies that rely heavily on energy, airlines, logistics firms, manufacturing industries, see their margins shrink. Some may report losses, others may issue warnings about future performance. Investors react quickly to these signals. Stock prices can decline, sometimes sharply, as expectations are revised downward. This creates a wealth effect. When markets fall, people feel less financially secure and reduce spending. This further slows economic activity. At the same time, bond markets respond to rising inflation and interest rate expectations. Yields increase, making borrowing more expensive for governments and businesses alike. Debt becomes harder to manage, especially for countries already facing financial challenges. This is where the crisis begins to spread beyond energy. Emerging markets are often hit the hardest. Many of these countries rely heavily on imported oil and have limited financial flexibility. As fuel costs rise and currencies weaken, they face increasing pressure on their economies. In some cases, this can lead to debt crises. Governments may struggle to meet financial obligations. International assistance may be required. Economic instability can lead to political instability, creating a cycle that is difficult to break. Meanwhile, developed economies are not immune. Even countries with strong financial systems can experience significant slowdowns. Consumer confidence declines, business investment weakens, growth forecasts are revised downward. Global trade also begins to suffer. As costs rise and demand weakens, trade volumes decrease. Supply chains, already strained by disruptions, become less efficient. This further increases costs and reduces economic activity. It's a feedback loop. Higher costs reduce demand. Lower demand reduces production. Reduced production leads to layoffs and lower income. Lower income reduces demand even further. And all of it can be traced back, at least in part, to rising energy costs. Another critical aspect is energy substitution. In theory, high oil prices should encourage the use of alternative energy sources, but in practice, this transition takes time. Infrastructure, technology, and investment are required, and these cannot be scaled up instantly. In the short term, the world remains heavily dependent on oil. This means that even as prices rise, consumption does not fall immediately. Instead, people and businesses absorb the higher costs, at least until it becomes unsustainable, and that delay allows the shock to deepen. Eventually, demand may decrease as prices become too high, but by that point, significant economic damage may already have occurred. This is why oil shocks are so powerful. They affect both supply and demand, both costs and expectations, both short-term behavior and long-term trends. They don't just create temporary disruptions, they can reshape economic conditions for years. Right now, the world is approaching that critical point. Prices are under pressure, supply chains are strained, inflation risks are rising. Policymakers are watching closely, trying to anticipate the next move. But the system is highly sensitive. A single escalation, a further disruption in supply, a political decision, a sudden surge in demand could push it over the edge. And once that happens, the transition from pressure to crisis can be very fast. The Iran oil shock is no longer just a possibility, it is a developing reality. And if the current trajectory continues, the next phase may not just be about rising prices, it may be about a global economic slowdown or even a full-scale recession.
Once an oil shock reaches the stage where prices surge and inflation spreads across economies, the next phase becomes much more serious. This is where the crisis moves beyond markets and into the real structure of global economic stability. At this point, the risk is no longer just higher prices. It becomes the possibility of a full-scale global recession. A recession doesn't begin with a single event. It builds gradually as multiple pressures converge at the same time. Rising energy costs, slowing consumer demand, tightening financial conditions, and declining business confidence all start reinforcing each other. And oil sits at the center of that storm. As fuel becomes more expensive, businesses across industries begin cutting back. Manufacturing slows because production costs rise. Transportation companies reduce operations as fuel eats into profits. Airlines cancel routes or increase fares to levels that reduce demand. This creates a ripple effect. When businesses slow down, they need fewer workers. Hiring freezes begin. Overtime hours are reduced. In more severe cases, layoffs start to appear. At first, these changes are small and scattered, but over time, they become more widespread. Unemployment begins to rise. When people lose income or fear losing their jobs, they reduce spending. This drop in consumer demand hits businesses even harder, forcing further cutbacks. The cycle feeds on itself. This is how a slowdown turns into a recession. At the same time, central banks like the European Central Bank and the Federal Reserve face one of the most difficult policy environments possible. Inflation is rising because of high energy costs, but economic growth is weakening. Normally, central banks would lower interest rates to support growth during a slowdown, but if inflation is still high, doing so risks making the problem worse. So instead, they may keep interest rates elevated or even increase them. This decision has consequences. Higher interest rates make borrowing more expensive. Businesses delay expansion plans. Home buyers step back from the market. Credit becomes tighter across the system. This reduces economic activity even further. What emerges is a synchronized slowdown across multiple sectors at once. Housing weakens, manufacturing contracts, consumer spending declines, investment drops, trade slows. And because today's global economy is so interconnected, these effects don't stay within national borders, they spread. Countries that depend heavily on exports feel the impact when global demand falls. Nations reliant on imported energy struggle with rising costs and weakening currencies. Financial markets transmit shocks instantly from one region to another. This is how a regional energy disruption can evolve into a global recession. But not all countries are affected equally. Some nations are particularly vulnerable to an oil shock of this magnitude. These are typically countries that rely heavily on imported energy and have limited financial reserves. For them, the crisis hits from multiple directions at once. Take countries like India and Bangladesh, for example. Both depend significantly on imported fuel to power their economies. When oil prices rise, the cost of electricity generation, transportation, and industrial production increases sharply. Governments may try to shield consumers through subsidies, but this places a heavy burden on public finances. Budget deficits can widen quickly. Currency pressure increases. Inflation becomes harder to control. Over time, these pressures can lead to difficult policy choices. Should governments continue subsidizing fuel and risk fiscal instability, or should they allow prices to rise and risk public dissatisfaction? There is no easy answer.
In some cases, countries may turn to international institutions like the International Monetary Fund for support, but such assistance often comes with conditions, spending cuts, policy reforms, and structural adjustments that can be politically sensitive. Meanwhile, oil exporting countries experience a different kind of impact. Higher prices can increase their revenues significantly. Nations in the Middle East, for example, may see short-term financial gains from elevated oil prices, but even for them, the situation is not entirely positive. Global recessions reduce demand. If economic activity slows worldwide, the demand for oil eventually decreases, putting downward pressure on prices. This creates volatility, periods of high revenue followed by sudden declines, and volatility is difficult to manage. Another important dimension is geopolitics. Economic stress often leads to increased political tension. Governments under pressure may adopt more aggressive policies, both domestically and internationally. Trade disputes can intensify, alliances may shift, conflicts can escalate. Energy, in this context, becomes not just an economic issue, but a strategic one. Countries may compete more aggressively for access to resources. Long-term energy agreements become more valuable. Strategic partnerships are reevaluated. We may also see accelerated efforts towards energy independence. Countries that have the ability to invest in alternative energy sources, such as renewables, nuclear, or domestic fossil fuel production, may push harder to reduce reliance on imported oil. But again, these transitions take time. They do not solve the immediate crisis. For ordinary people, the effects of a recession driven by an oil shock can be deeply personal. Rising prices reduce purchasing power. Job security creates stress. Savings may be depleted to cover everyday expenses. The economic crisis becomes a social one. And history shows that prolonged economic hardship can lead to broader consequences, protests, political changes, shifts in public sentiment. Governments that fail to manage the crisis effectively may face significant challenges. Another key aspect is how long the shock lasts. Short disruptions can be absorbed, markets adjust, supply chains recover, prices stabilize. But prolonged disruptions are far more damaging. If the situation involving Iran continues to restrict oil flows for an extended period, the cumulative impact becomes much larger. Reserves run down, financial buffers weaken, policy options become more limited, the system loses flexibility. And once that happens, recovery becomes more difficult. There's also the risk of secondary shocks. For example, if high energy costs lead to a financial crisis in one region, that crisis can spread through global financial systems. Banks may face losses, credit conditions tighten further, confidence declines. This creates a multi-layered crisis, energy, economic, and financial all at once. Right now, the world stands at a critical juncture. The early stages of the oil shock have already begun. Supply chains are strained, prices are rising, inflation pressures are building, central banks are under stress. But the full economic impact has not yet been realized. Whether this situation turns into a severe global recession depends on several factors: how long the disruption lasts, how governments respond, and whether additional shocks occur. There is still uncertainty, but the risks are real and they are growing. Because once an oil shock reaches this stage, it is no longer just about energy. It becomes a test of economic resilience, political stability, and global cooperation.
Every crisis, no matter how severe, eventually reaches a turning point. The Iran oil shock will be no different, but the way it ends and how long it takes to get there will determine whether this becomes a short-term disruption or a defining moment in global economic history. The first possible path to recovery is de-escalation. If geopolitical tensions involving Iran begin to ease, even slightly, markets will react almost immediately. Oil doesn't just respond to physical supply, it reacts to expectations. A single announcement, a ceasefire, or even indirect negotiations can calm fears and bring prices down before actual supply improves. This is because uncertainty carries a premium. When risk is high, prices include that risk. When tensions ease, that premium fades. Tanker routes reopen, insurance costs drop, shipments resume more predictably, and slowly the pressure on global supply chains begins to ease. But de-escalation is not guaranteed. If tensions persist or worsen, the crisis could extend much longer than expected. In that case, the world would need to rely on structural adjustments rather than quick fixes. One of the most important tools in this phase is strategic reserves. Countries like the United States can release oil from emergency stockpiles, such as the Strategic Petroleum Reserve. These reserves act as a buffer, helping to stabilize supply during disruptions. However, this is not a permanent solution. Reserves are finite, and once they are used, they must eventually be replenished. Using too much too quickly can create vulnerabilities later. Governments must carefully balance immediate relief with long-term security. Another potential stabilizing force is increased production from other oil-exporting nations. Countries within groups like OPEC may decide to raise output to compensate for lost supply. Non-OPEC producers, including the United States, may also increase production, particularly from shale oil fields. But here's the challenge: production cannot be increased instantly. Bringing new supply online takes time, investment, and infrastructure. Even in the best-case scenario, there is a delay between decision and impact. During that delay, markets remain tight and prices stay elevated. This is why oil shocks often last longer than expected. Another key factor in ending the crisis is demand adjustment. As prices rise, consumption eventually begins to fall. People drive less, companies optimize logistics, industries reduce output or shift to more energy-efficient processes. This reduction in demand helps rebalance the market, but it comes at a cost. Lower demand often reflects reduced economic activity. Factories slow down, services contract, growth weakens. In extreme cases, this demand destruction is what ultimately brings prices down, not an increase in supply, but a decrease in usage. It's an effective but painful correction. At the same time, the crisis accelerates long-term changes in the global energy landscape. High oil prices make alternative energy sources more attractive. Investments in solar, wind, and other renewables increase. Governments push for energy diversification. Technologies that were previously considered too expensive suddenly become viable. This shift is not new, but crises like this speed it up. Countries begin to rethink their dependence on vulnerable supply routes. Energy security becomes a top priority. Policies are introduced to encourage domestic production, storage capacity, and alternative energy development. Over time, this can lead to a more resilient system. But again, these changes take years, not months. In the short term, the world must navigate the immediate consequences of the shock. In the long term, it must adapt to prevent similar crises in the future. Another possible outcome is a restructuring of global alliances. Energy relationships often shape political relationships. During a crisis, countries may seek new partners, sign long-term supply agreements, or strengthen existing alliances. This can shift the balance of power in global energy markets. New trade routes may emerge, new suppliers may rise in importance, traditional dependencies may weaken. In that sense, an oil shock is not just an economic event, it's a geopolitical turning point. For businesses, the lesson is clear: resilience matters. Companies that can adapt quickly by managing costs, diversifying supply chains, and improving efficiency are more likely to survive and even thrive during a crisis. Those that cannot may struggle or fail. For governments, the challenge is even greater. They must manage inflation, support economic growth, maintain social stability, and navigate complex geopolitical dynamics, all at the same time. Policy decisions made during this period can have long-lasting consequences. For individuals, the impact is more immediate, but equally important. Higher living costs, job uncertainty, and economic volatility affect daily life. But crises also create opportunities for innovation, for new industries, for changes in behavior that can lead to more sustainable systems. The key is adaptation. Looking ahead, one of the most important questions is whether this crisis will fundamentally change how the world uses energy. Will it accelerate the transition away from fossil fuels? Will it lead to greater investment in energy security? Will it reshape global economic priorities? The answers depend on how governments, businesses, and societies respond. History suggests that major shocks often lead to major changes. The oil crises of the 1970s led to energy efficiency improvements, strategic reserves, and new policies that shaped decades of economic planning. The current situation has the potential to do something similar, but on a larger scale. Because today's world is more interconnected, more energy dependent, and more complex than ever before. And that means the impact and the opportunity is greater. As the Iran oil shock continues to unfold, one thing is certain: the outcome is not predetermined. There are multiple paths forward. A rapid de-escalation could limit the damage and allow for a relatively quick recovery. A prolonged disruption could trigger a deeper and more lasting economic shift. Or the crisis could evolve in unexpected ways, influenced by factors that are difficult to predict. What remains clear is this: oil is not just a commodity, it is a foundation of the global economy. And when that foundation is shaken, everything built on top of it feels the impact. The world is now entering a period of uncertainty, one that will test systems, challenge assumptions, and force adaptation at every level. The Iran oil shock is not just about energy, it is about how the modern world responds to disruption. And in that response lies the future.